Welcome back everyone to the second session of the workshop today. So in this session we're now going to look at two questions. So the first one we're going to do looks at the general deduction formula, which is section 11A. And this question, it asks you to discuss if an amount is deductible. So this is similar to a theory type question that you would receive in a test or an exam. So we're going to discuss how do you actually go through the information and how do you then document it to score the marks that you need. And then the second question we are going to look at is in question 6.1, which then combines some of the general deductions as well as the capital allowances and specific deductions, and how do you actually document that when you do the taxable income calculation. So we're going to look at those two types of questions. So like I've always said, is when you start with a question, the first thing you need to do is you go read what is the required. Okay, so in this case, they ask you, discuss with reference to case law. So they specifically tell you to use case law. If you see that, marks will be allocated to that. So you need to document the case law that relates to that information. So on the slides that I've provided, I have documented the most important case law relating to specific sections. So make sure you know that for your test, for your exam. And then they ask you whether BigSlam Pro will be able to claim the payment as a deduction in terms of the general deduction formula. So they tell you just focus on section 11A. Don't go look at any specific deductions. They just want to know in terms of the section, can you deduct it, yes or no? And then they give you the year of assessment. So in this case, which is 2021, so when we talk about year of assessment for 2021, let's quickly see what's the year end. The year end is 28 Feb. So that would mean the year is 1 March 2020 up to 28 February 2021. So that is your tax period. Okay, then part B, they wanted to know, based on the principal received by a taxpayer means in the gross refers to case law. So that was based on what we discussed in Monday's class. We're just going to focus on the expense in this section, but I will provide you with the solution for both after the class. Okay, so let's go through the information that they've provided to see what type of information has been given to us. So the first thing they tell you is BigSlam sells golfing equipment and golfing clothes at its pro shop and is responsible for renting golf carts to golf players. So they also rent golf carts at the pro shop. Okay, and then they tell you the year end is 28 February. Then on 28th of February, 28 December, they hosted a golf day where golf carts were rented. So they hosted a golf day and they rented golf carts out. On the 3rd of January 2021, they received a claim from John Best, who participated in this golf day and said he sustained injuries due to a golf cart accident on that day, and that was because the brakes failed. Then they settled this outside of court on the 31st of January, and BigSlam would pay $10,500 as damages, and that was what was agreed between the two parties, and the payment was made on the 10th of March. Okay, now the type of information we need to look at is, if we look at the general deduction, we first have to see, are they actually carrying on a trade? Now, the information here that would sort of indicate whether they are carrying on a trade is generally in the introduction paragraph. So they are carrying on a trade because they are selling golfing equipment and golfing clothes, and they're also responsible for renting golf carts. And this is part of the pro shop. So that is the trade first. Then the year of assessment would generally be year. So I'm just going to make this year of assessment. So we said it's 1 March 2020 up to 28 February 2021. So what that means is I need to look at this date range to determine if the expense that was paid here at the bottom, does it actually fall in this date, So we will see that they've settled the claim on the 31st of Jan, but they only paid it on 10th of March. So that is where the year of assessment will become vital when you talk about it. Okay, then we have to look at, do we have an expense or loss? Now, we have expenditure here for the claim of 10,500. Okay, so we've got an expense that we need to pay here. Okay, then in the production of income. So the question is, was this in the production of income? And this is where your case law will come in to help you motivate if it was part of the production of income, yes or no. Okay, and then the other thing is we need to see if it's capital in nature. Does it create an enduring benefit? Okay, so as you go through the questions, these are the things you need to jot down so that when you answer the question, you actually cover all of the information. Okay, so when you get a question like this, what is very important is that you go list all of the criteria, because you actually get marks for listing each of the criteria. So you can either do it in a table format like this, or you can just write the heading and then underneath the heading go and apply the information based on the question. Okay, so the first thing we said, are we carrying on a trade? Now, based on the information, we said yes, we are carrying on a trade because we are selling golf equipment, golf clothes, and that constitutes a trade based on the definition. Okay, so that is seen as carrying on a trade. You would have received the mark for that. Then the next thing we would have to discuss is, did we actually incur expenses or losses? Now, we said the claim that was received from the customer, that 10,500, because this amount was paid in March, this was actually then seen as an expense. So we have actually incurred an expense of 10,500, which was resulted of the claim. Now, when we talk about actually incurred, now we have to discuss, have we actually incurred that expense in our tax period? So the tax period we are referring to is 1 March 2020 up to 28 Feb 2021. So did we incur that expense in that tax year, or did we only incur it in the following tax year? Okay, now what we have to look at is, we said when something has been incurred, it needs to be unconditional. There should not be any, it's an unconditional liability, and the court case that talks about that is the National Pash BP case. So you then say an amount is actually incurred in the company if it's unconditional liability to pay the amount based on that court case, and you would have received a mark. Then we have to say, okay, but let's now look at when was it actually incurred. We had a dispute because of that claim resulted in a dispute resulting in the injury. So normally when we have a dispute, the court cases say, the Golden Dumps court case says that once the outcome of the dispute has been determined, that is when it's actually incurred. So prior to that date, it would not have actually been incurred. So then we say, because there's a legal dispute, we only say it's actually incurred once that outcome has been determined. Now that is what the court case says. So that also means that it's an unavoidable cost that is closely related to our business. So that expense was closely related to our our business. Okay. And the claim that was settled outside of court was the 10,500, which we also listed here as the expenditure. Okay, now we agreed on the 31st of January that we are going to settle this amount. Now that means on that date when we reached the agreement, so on the 31st is when it was actually occurred. That is when it became unconditionally liable to be paid. Okay, and that date is still within our year end. Then if we look at year of assessment, so even though this amount was paid based on the information on the 10th of March, because the agreement was reached on the 31st of January, we would have actually incurred it in the year of assessment. So even though this amount is paid after year end, because the agreement happened in the year of assessment, it was actually incurred in that year of assessment, and you would have received the mark for that. Now, where the difficult part in this question comes in is, was this actually in the production of income? And in this question, you could actually go either way based on how you actually motivate it. So the first thing which the Elizabeth Tramway case said is, an amount is incurred is in the production of income. It needs to be inevitable, concomitant, and closely related to your business. Okay, so that is the first thing that you need to state, is the fact that it is part of the business. Okay, so it needs to be part of the business. Secondly, that it is an unavoidable cost that is closely related. But now the question is, was the cost actually an unavoidable cost that is closely related to the business? Now, this will depend on how you actually motivate it. So let's say you say, okay, fine, as a golf day, there is always a risk that an accident may occur. So as part of your explanation, you think that there's always risk with a golf day just based on the nature of a golf and how it works. Or if you were against it, so you say, okay, no, if I go look at the court cases, the Jaffe court case actually says that just because of the fact that you were negligent, you will not be allowed to deduct it as an expense. It would not be seen as unavoidable. Now, what could have resulted you to thinking that is a negligent is the fact that the brakes failed on the golf cart. And normally one would expect that management or the staff would have checked the vehicles before they actually gave them to the players to use. So in that case, you could have actually argued, okay, no, I don't think this would be deductible because it is part of the business negligence that this expense was incurred. Now, the next thing we need to talk about, is this actually capital in nature, yes or no? So that is where we have to look at whether it creates an enduring benefit according to the Rhodesian court case. So did this actually create an enduring benefit? No, it did not create an enduring benefit because the payment happened at a specific date and time. It is not for anything that we will receive in the future, so it is not capital in nature. So it didn't create an enduring benefit. Now, depending on what you've argued up here, your conclusion would actually differ here at the bottom. So if you said, okay, due to the fact that they hosted a golf day, it has its normal inherent risk that accidents may happen, you would actually, based on what you've written down, you would say, yes, all the requirements have been met, I can actually deduct it in terms of section 11A. However, if you felt no, but this was due to management's negligence, that this accident occurred and the expense was paid, then you would say no, because of the fact that it was part of the negligence, it is not seen as an unavoidable cost, which is part of the business, so you would not actually be allowed to deduct it, and for that reason, you would say no, it is not deducted, it is prohibited in terms of section 23. Okay, because it was not actually part of the production of income. So in this scenario, we would have marked both depending on how you would have argued it. Okay, before we move on to question 6.1, do you guys have any questions on what we've discussed here with the different components? Do you guys have any questions on the different components and the general deduction formula and how you should argue it when you get something like this in a test or in an exam? Okay. Then the next question is question 6.1, which you can find on page 96 and 97 of your workbook. Just going to make it a little bigger so all of you can see properly. Okay, so the first thing, just like every other question, let's start at the end with the you are required to see what we need to do. So they asked in this question that you calculate the tax liability for Guitar Pty Limited for the year of assessment ending 31st of March 2021. Okay, now when we have the tax liability, this is generally your taxable income multiplied with your tax rate. Now you can tell me, what is the tax rate for a company? Yes, Tanya, that's correct. So the tax rate for a company is 28%. So in this scenario, they wouldn't have given you a table. They would expect you to know what the tax rate is. Okay, now let's go through the information and see what type of deductions and income do we have. Now for this type of question, you would use your framework. But for today's question, I've just plotted it in as we go through the information to make it easier, because there was not a lot of income, so most of it was expenses. But generally, you would document it as gross income first, show all the income, and then any exemptions that would be deducted would be shown secondly, and then you would show all the allowable deductions, and then you would put it based on section 11, and then you would put the capital allowances after that. Now, because of the fact that we have not discussed capital gains as yet, you would not have included in this question. In the solution, they have shown you how to do the capital gains, because if you write an exam, they would require you to do the capital gains calculations even if the amount is zero. So even if it did not affect the capital gains amount. Okay, so let's go through the information. So the first thing, and they've bolded this information, is it is not a small business corporation. Now the reason they tell you this, that means that section 12E is not applicable and we do not use their tax tables. Okay, so this means section 12E not applicable. Okay, so that's the reason for it. So that means we will apply section 12C if we've got any manufacturing assets that we've acquired during the year. They tell you the company manufactures all kinds of music instruments, okay, including guitars, pianos, drums, and it sells these instruments to retailers. Their financial year end is 31 March. So that means their tax period runs from 1 April 2020 up to 31st of March 2021. Okay, so that is our tax period that we are looking at to see if something was actually incurred in that period. Then they tell you the accountant requested you to calculate the company's income tax liability for the year of assessment, and they provided you with the following information. Okay, so the first thing that is important, the company is a VAT vendor, all amounts are excluding VAT unless otherwise stated otherwise. Now, why is this information important? We said for your capital allowances, it is always an amount must be exclusive of VAT. Okay, so you need to specifically go look out for this, for the ones where they say unless specifically indicated. So you can assume all the amounts are excluding VAT unless they specifically tell you it's VAT, then you need to do something with that information. Okay, so the first thing they tell you is we have sales to Mood CC for 6.8 million and 65,000. So that information, I would automatically then go, just make this a bit bigger. Okay, I've already included the descriptions, but you would write them down as you go and do your calculation. Okay, so for sales, they've given the amount to us. We just go capture the amount of 6.865 million in our information. Now, because of the fact that this amount is given, this is called an easy mark. Okay, so I see I didn't assign a mark there, but normally you would get a mark for just capturing this information straight from your question. Then the next thing you see is donation of 150 was made to Lifeline, a registered PBO organization, and you got a Section 18 certificate. Now, why they have to specifically state it's a Section 18 certificate is for the Section 18A deduction, which is limited to 10% of the subtotal. Now this one you will not be able to calculate until you've done the entire calculation, because it is based on your net profit basically just before that amount to work out the deduction. So this one you would have to park up to the end. Then a company purchased raw materials, so this would now be Section 22, and the amount was 4.1 million, but here they tell you it's inclusive of VAT. So what that means is I need to go and exclude the VAT amount when I capture it. Because of the fact that I'm a VAT vendor, I would have claimed the VAT amount, and in terms of the prohibited information, I can't claim any taxes. Now VAT is seen as a tax. And then we've also paid transport cost of 8,600 to deliver that item. So I will also be able to claim the transportation cost. So we said any cost incurred in bringing that materials to its location or condition for sale would also be deductible. So you would show these two separately when you do your calculations. So the first one you would do is you would do the raw materials. We are excluding the VAT, so we're multiplying it by 100 over 115, or you can divide it by 1.15 and you would get the amount. And then you deduct that amount from the income, so it's a negative amount. And then your transport, because it was shown separately, that amount is exclusive of VAT, so you would just capture that full amount for 8,600 in your calculation. Then point 4, if we read point 4, Guitar Hero created a new computer program that would simplify the manufacturing process. The research and development expense, so here they tell you it's a research and development expense, amounted to 375,000 for the computer program, and the salaries for the staff also for that staff is 98,000 were incurred on the same date. Here they tell you that approval was obtained, so you know it's been approved. It is an expense, it is approved, and was developed for computer program on 15 April 2020. Okay, now what did we say is the requirements for this? For the deduction of our RD expense, we said it needs to meet the requirements, it needs to be approved, and there was one more thing. Oh, it incurred in South Africa. Now, for this scenario, you can assume that it is in South Africa based on the fact that they tell you they sell it to retailers in South Africa. So you can assume it was done for the South African market specifically. Now, if the three requirements have been met, then we said we are allowed to deduct 150% can be deducted as the three requirements were met. Okay, did someone raise their hand? Does someone have a question? Is there any questions on this? Okay, so because of the fact that these requirements are met, then you know for the R&D expense, you are allowed to get 150% of the deduction. So what it means is you go and add the 375,000, which is what we incurred for the program. You add any staff costs or any additional cost, you add these two together first, and then you multiply that with 150%. So you would have received half a mark for showing the two separate amounts, and then you would have gotten a full mark for actually doing the 150% because of the fact that the three requirements have been met. Then at point 5, we're talking about the bad debts. So the bad debts that were written off during the year of assessment is 58,960. Now, because of the fact they don't provide you with further information, you can assume that the income was previously included. If they specifically state that a portion was not included in income previously, you would deduct that amount from the deduction. But in this case, because they've left it open, you will be able to deduct the full amount. Okay, then the next item, we're looking at the list of doubtful debts. Now, I said that if they don't tell you the specific periods, whether it's 50 days, whether 60 days, 120 days, then you assume that you only use the 25%. So they tell you they did not apply IFRS 9. So we would either have 25 or 40%, but because they left this information open, we would apply only the 25%. Okay, and then we have to add back the prior year's deduction as well. And this would normally be included in the income, but for this scenario, I've just shown it together so that you can see how it is calculated. So when we do the doubtful debts, you have to show both amounts. You show the current year's deduction and the prior year. So now we're adding back the prior year, which was the 112,000 multiplied with 25%. So that's what we would have deducted last year. You add it back. And then in the current year, our list of doubtful debts is 97,000. Then I apply the 25% to that, which is then a negative 24,250. And what we are, in essence, including in our tax calculation is just the movement from the one year to the next, which would have been a positive movement of 3,750. But to get the marks, you need to show that amount separately. Okay. Then if we go on, they tell you the following information relates to the fixed assets. So as soon as you see fixed assets, you need to think about capital allowances. Okay, so that can be section 11E or section 12C or section 13, which relates to buildings. Those are the sections that you would need to think about because of the fact that we don't have a small business corporation. So the first thing they tell you is on the 1st of August 2019, we purchased new furniture for 41,040, including VAT, for the distribution office. Then on the 1st of October 2020, we relocated the furniture and we incurred moving cost of 15,000. Now, what we do for moving costs is the moving cost would then be depreciated over the remaining period. Now, we will see further in the question what is the normal depreciation period for furniture. So that is just something you need to take in consideration. If it is for a short period of time, it would be 3 years. So it will be the lesser of the remaining period or 3 years, depending on what it is. Then we see old furniture. So second point, old furniture was sold on the 1st of August to a second-hand dealer for 18,000. So that's the sales price. And it was originally purchased for 25,000. Now, when you read something like this, what you need to consider is it a scrapping allowance, which is section 11O. Sorry, let me just make it a bit bigger again. Okay, so scrapping allowance, or is it a recoupment, which is section 8.4a. Okay, now that is, did I make a profit on it, or did I make a loss? Now, if it's a scrapping allowance, I made a loss on a depreciable asset, then I'm allowed to get an additional deduction. If I made a profit, then the tax rule says I need to be taxed on the profit I made on any asset I was allowed to deduct previous expenses for. Now, in this case, because we're just looking at expenses, it's going to be the scrapping allowance, but in a test or exam, it can be either one of the two. The calculation is the same. You will then just have to determine whether you add or subtract it. So for this, you will have to determine the tax value, which is your carrying amount. Okay, and then we purchased 2 manufacturing machines on the 1st of July. Now here you need to go look at whether it's new or unused machines because of the rules. So if it's a new or unused, it would be the 40-20-20-20 rule. If it is a second-hand one, it would be the 20% over 5 years. So in this case, you will see machine A was new for 220, whereas machine B was a second-hand one, so it's a used machine, and we bought it from a non-vendor. Now, I said when we buy something from a non-vendor, we have to exclude the notional input VAT from this transaction when we do the calculation. Okay, they said all the other amounts are excluding VAT already, so, but this one, because they tell you it's a non-vendor, they are assuming that you are aware of the fact that it includes VAT, this amount. And then we purchased 5 new apartments, okay, in a residential building for 650 each. Now we said for building allowances, it is 5%, but if it is purchased new, we have to apply the 55%. Okay, so it's the 5% per annum, and then we apply the 55% because it's a new purchase when we do the calculation. And then we look at the rental income. Now in this case, the rental income is 3,000 each per month, and that is less than the 1% of the 650. So that means we use the 5%, And then this amount also needs to be included. Include that into our gross income, this rental that we've received. Okay, now let's quickly look just where they told you the furniture. So here they tell you furnitures and fixings is 6 years is the write-off period. Okay, so if we go back and they say Guitar Hero uses the Section 11.0 scrapping allowance if applicable. So if we made a loss, then we apply that scrapping allowance. So you can elect to use it or not. Okay, so if we go back, now we know this is over 6 years. So to work out the remaining period, we have to see, okay, how many periods are remaining? So if it's 6 years, so initially 6 years would equal 72 months. Now, if we look at what date we are at now, we are on the 1st of October. So from the 1st of August 2019 up to the 31st of July would have been 12 months. Then we've got August, September, October, which is another 3. Okay, let me just quickly count there. So it's August, September, October, November, December, Jan, Feb, March, April, May, June, July, August, September. So 14 months. Okay, so 14 months has already expired. So that means when we look at the remaining period, is the 72 less the 14, which gives us 58 months is remaining, which we will use for our moving cost. Okay, so let's then go to our question now. So for the furniture, what we have to do is the first thing, we have to go work out the wear and tear for the furniture, that 41,040 Rand. Now, we said we have to exclude the VAT when we do these calculations. So you take the original cost, excluding the VAT, and we divide it by 6. So we had that asset for the entire year. So we write off the depreciation. Then the moving cost, we said we write it off over the remaining period. So we've worked out now that the remaining period, if you work it out, is 58 months. So we are going to deduct that amount over the 58 months. But because it only relates, we only moved in October. Our year end is end of March. So we had it for October, November, December, January, February, March, which is 6 months. And therefore, we then multiply it with the 6 months to get to an amount of 1,552 Rand. Okay, so you would have received 1 point for your 58 months, and then you would have got 1 mark for the physical calculation in this scenario. Then if we go to the second point, we said old furniture was only sold on the 1st of August. So that means from April, May, June, July. So 4 months we've actually had that property in the current year. But to work out if we made a loss or a profit, we have to work out the carrying amount. So what we do in this scenario is we do the calculation of the original cost and then the depreciations from the date we've purchased it. But because only this element relates to our current tax period, we will only include that amount in our deduction. Then our tax base, which is also our carrying amount, is our cost less the accumulated wear and tear we've deducted. So our cost or tax base is 20,000. But we've sold it for 18,000. So the loss that we made is the difference between the 18,000 and this 24,000. Now, normally it is limited to the lower of your actual sales price or your cost. Now, in this scenario, the sales price is the lower of that and the cost. So we use the 18,000 and we deduct the 20,000 that we've calculated, which is the tax base, to give us the deduction of 2,486 Rand. Okay, so that's how you work out the scrapping allowance. Now, what I said is it's not applicable for what they've asked in this question because we haven't done the capital gains as yet, but you would have included the capital gains calculation as well, even though it would have been zero. So our proceeds would have been the 18,000. You would have done the base cost, would have been the tax base, less the scrapping allowance would have given you the base cost, and your capital gain would have been zero. So you would have also included that calculation when you did that in an exam, and you would have received additional 3 marks for doing that. Then the next item, we purchased 2 manufacturing machines. We said the one is new, one is used. So for the one, we apply the 40-20-20-20 rule, and the other one, we apply the 20-20 rule. So for the new machine, because it's the first year we're bringing it in, we multiply it with 40%. For this specific section, we do not apportion it at all, so you get the full deduction. For the used machine, what I said we need to note here is it is from a non-vendor, so there is notional input VAT included in that amount. So we first have to take out the notional input VAT and then work out the calculation based on 20% to get to the deduction you're allowed to deduct. Then if we look at the building allowance, we purchased 5 new apartments for 650 each. So we said the allowance we are allowed is 5% per unit. And because it's new, we have to apportion it at 55% to work out the deduction. So you take the 650, because it's the price per unit, you multiply it with the 5 units that we've purchased, you multiply it with the 55% because it's a new item we've acquired from a developer, and then we apply the 5% capital allowance to work out the deduction. But now in the question also, they told us we received rent of 3,500, so you include that as well for the number of months. Now, because we purchased it on the 1st of May, it is only for 11 months. So you would multiply the 3,500 for 5 units for 11 months to give us additional income of 192,500. Then we said we paid electricity, paid an amount of 110,000 for water and electricity, but here you see the period is from 1 March to 31st of December. Now, because our year end is 31st of March, we have a prepayment of 9 months. So we have to go look at section 23H to determine how do we actually deal with this. So the first requirement we look at is the portion that was prepaid. So that would have been the 110,000 times 9 divided by 12, which would have given you an amount of 100. We know this will occur within the next 9 months, so it is not within 6 months. So that requirement has not been met. The second requirement is this amount less than 100,000. Now, because I've already gone through the rest of the information, I know there's no other prepayments. So this amount is then less than 100,000, which then means you can deduct it in the same period. But for disclosure purposes in your test, okay, so for the 11 over, ma'am, quick question. So if ever it is 11 months, do we multiply by 11 and not 12? Okay, so are you implying that we did not have a full 12-month year? Is that what you mean? Okay, so if, for example, we had our tax period or the period that we've traded for was less than 12 months, yes, then you would divide it by the number of months the business was actually in business for. Okay. But because this payment is specifically, they told you it's for a year, you apply the 12 months. Okay, so the first thing, we show the actually incurred for the 3 months for our tax period. So you first show that deduction in terms of section 11A. Then you show for the prepayment that, okay, we had a prepayment of 110 for 9 months, which equals 82,500. But because it's not incurred in less than 6 months, but it is less than 100,000, we can then deduct that full amount. So you need to show the prepayment element as well. If we were not allowed to deduct it, you would show 0 here, and you would then also get a mark for that. So you need to specifically indicate that there is a prepayment and whether you're allowed to deduct it, yes or no. Okay, then we've got the following employee expenses, which is your salaries and wages, which was 1.2 million. Then your contribution to your medical aid fund, which was 155,000, and then leave pay of 54,000. Now the leave pay, because we've actually paid it, it does not fall under the provision section, which is specifically excluded. If it was a provision for leave pay, then it would have been prohibited. So based on this information, you would be able to deduct all 3 amounts because of the fact that they were actually incurred. Okay, so this is what this means. Normally leave pay is a provision in our accounting records, but because we've actually physically paid this amount, we can deduct it. Then on the 1st of February, there was a robbery, and 5 guitars were stolen for 550 each. And in an attempt to recover, the company paid a bribe. So we paid a bribe of 1,500 to try and get the things back. And then our insurance company paid an amount of 20,000. So we said for theft, we are allowed to claim the loss that we made, but only to the extent that we did not recover a portion from the insurance company. So because we recovered the 20,000, we have to reduce the loss with the insurance payment or repayment. And then the bribe is prohibited. So what we do is the first one, we show the loss that we've made. So you take the 5,500, you multiply it with 5, and then you deduct the 20,000 to give you a net amount we can claim of 7,500. And then you include the bribe money as a 0 because of the fact that it is prohibited. Okay. Now we said you first have to do all of the expenses before you can do section 18A. So now you then sum up to get the subtotal for the amounts. And then section 18A is limited to 10%. So we take the 150,000. If we work out the limit, it's 92,510, which is 10% of that, which is less than the 150,000. So we will only be allowed to deduct the 92,518. And then we work out the taxable income by adding those 2 amounts. Now our normal tax, we said, is 28%. If they indicate any provisional taxes paid, you would deduct it from that amount, and then your net tax payable would be the difference. But in this scenario, there wasn't any prepayments made, so the tax that you would have to pay is 233,146 rand. Okay, so do you guys have any questions on question 6.1 and how you get to the answer?